In this video, we will go over some key points regarding the income statement. A lot of this will be a review as we've covered this content in previous videos. I will also point out a few new things and mostly just want to summarize what we've already talked about. Let's first look at a sample income statement. We have seen something similar to this already in the budget exercise we did in the Business Math and Excel module. I want to point out a couple of things here. We have a line item here titled Other Operating Expenses. You will see this line item titled many different things on companies' income statements. Another common term is operating overhead, or general and administrative expenses. This line item typically holds expenses such as salaries and utilities, basically anything to keep the business running that is not directly attached to the cost of inventory. Next, we have an item here titled Loss on Sale of Plant Asset. This account would be used by a company who sold an asset they were using in their business. Let's look at this concept a little bit more closely by looking at the difference between revenues and gains and expenses and losses. We'll look at this in the context of some income statement rules. On the income statement, we have revenues and gains. These are positive items, meaning that they're good, but also that their balance is positive. They add to net income. We also have expenses and losses. These are negative things, meaning they subtract from net income. Revenues and gains may seem similar, and expenses and losses may seem similar, and they are in that they have the same impact on net income. But there is an important distinction between these items, between revenues and gains, and then between expenses and losses. Revenues and expenses result from the daily operations of our business. Gains and losses occur in the less usual course of our business. For example, let's say I'm Nike. I am in the business of selling shoes. If I sell shoes, I record that as revenue, and my expenses for those shoes go into cost of goods sold, and likely some indirect expenses go into other categories like salaries. Those revenues and expenses are part of my normal operations. However, if Nike sells a piece of equipment they use to make shoes, then they would not record revenue for that transaction. They would record instead a gain or a loss. Nike is not in the business of selling equipment. They're in the business of using that equipment to make and sell shoes. There is a company out there that sells equipment to make shoes. Let's call them ABC Equipment. They're the company that makes the equipment that Nike buys to use in their business. Since it is part of ABC Equipment's everyday business to sell equipment, ABC would record revenue when they sell equipment, but Nike wouldn't record revenue when they sell that same equipment. They would either record a gain or a loss. Let's review some other income statement rules. We just covered this first one. Revenues and expenses occur from daily operations, and gains or losses occur through more unusual transactions. Our second rule that we need to consider is that gross profit is an important subtotal. On the income statement, we have to show that subtotal. If we go back to the income statement, we can see that subtotal here. Sales minus cost of goods sold gives us gross profit. What we're basically doing is setting cost of goods sold separate from all of the other expenses and losses that we have. Another rule is that net income represents earnings over a period of time, not at a point in time. Remember, the balance sheet represented a point in time. That is not the case with the income statement. The income statement represents earnings over a period of time. So from January 1 of this year to December 31st of this year, it's representing all of the activity that happened over that period of time. Whereas the balance sheet would just show us the ending balance at December 31st. If we look back at our sample income statement, it says for the period ended up at the top. That's what we're saying with that last rule on the income statement. is that it's over a period of time. It's for that entire period that ends on 12/31. Again, this means the net income represents all of the earnings for that period. It's a total across the period. Because of this rule, there's a few other things we need to note about the income statement. We talked about these items in the last video on stockholders' equity when we were talking about retained earnings. Because net income represents earnings over a period of time, net income closes out at the end of every period. That means the beginning balance in net income each period is 0. So we start net income over every period. We start at 0, and then we add any net income or subtract any deficits in net income over the course of the period. At the end of each period, we wipe the slate clean with net income, and we move net income from the current period into retained earnings. Remember, retained earnings includes all of the net income back to the inception of the company, minus any dividends that have been paid out to shareholders. In the next video, we need to talk a little more about the rules of recognizing revenue and expenses.